Hello and welcome to this special interview here on Money Paathshaala. Joining me today is one of the smartest people in the mutual fund industry. Looks very young, but 20 years of experience behind him, very fitness conscious, a role model for a lot of young people who are doing well professionally at a young age as well. Akhil Chaturvedi, who's the director and chief business officer at Motilal Oswal Asset Management Company, but has worked with other mutual funds as well during this 20-year period, so carries a lot of rich experience. Thank you very much, Akhil. It's always a pleasure talking to you. My first question, a lot of investors one speaks to or sees the commentary, they seem to be getting kind of tired about the fact that for 2 years, this market hasn't really moved anywhere significantly. It's been largely flat if you look at Sensex to Sensex. Now, we've always been saying that the nature of equities is actually that, but then the ground reality is people then say, and then simultaneously, and I'll talk about that a little bit more when it comes to asset allocation. Simultaneously, they see other asset classes doing well, and so what is your own experience? You've been traveling, you've been hitting the ground, interacting with investors. You have your own investors. What's the kind of sense you're getting? Are people getting impatient?
Yes, Vivek, thank you first of all for all the good words about me. Thank you so much. So this is a very, very important question, Vivek. Certainly when investors come into equities with a lot of conviction, and this happens generally when the markets are very, very exciting and the markets are in a bullish mode. That is the time we see a lot of excitement in the investors and a lot of flows come in those times. And often after good times there are bad times, and after bad times there are good times, right? So this is all about market cycles. What we have seen in the near recent past is that those who have come in the period 18 months or thereabouts, there is some amount of dissatisfaction, there is some amount of curiosity that when will they make returns, because at this stage they would be sitting on 0 to 5% kind of a band, not lost money but not made equal to or higher than fixed income returns. So to that extent there is a little bit of anxiety. But certainly, last time also we discussed this, that the maturity level of the investors certainly has improved or has gone up. So while they are impatient, but it's not reached a stage where they cut loss and move out. So we have not seen a spike in redemptions and people stopping their SIPs or people moving out lock, stock and barrel, because the numbers are visible month on month. The SIP numbers are moving up. Lump sum sales are also moving up. As a category, equity assets have gone up. So we see the trend with a lot of maturity in the investors who have come, let's say, a year and a half back. And we continue to see new investors also selectively come inside. The velocity of inflows could be different, as I said, from different cycle perspective, but it is still positive. So in the recent past, certainly Indian investors have come off time. But to your channel, I just want to explain to all investors, and I am also investor, you are also investor. In 23 years of my experience in equity markets and working with mutual funds, we always talk about investing in equities with long term, and we never define long term. Now, why do we say, you, me, newspapers, articles, best of the best, and everybody will say come into equities for long term. Now, long term, why we say is that typically we don't know that which years the market cycles will be positive and which years the market cycle will be negative, or which years the market cycles can be sideways. Like Ramdoji once said that one long term is equal to average of good times, bad times, and neutral times, right? So when you live through all these cycles is where you make the average of 12 to 15%, right? So coming into markets in good times and expecting good times to continue thereafter generally doesn't happen. So irrespective, when you come in a good time or you come in a bad time or you come in a neutral time, Once you cross through 2-3 cycles of ups and downs is when you will reach an average of 12 to 15%. Usually this happens in a 10-year plus kind of a time horizon. But timing the market that I will come now and I will go then, that generally doesn't work. And the biggest hedge to making a 12 to 15% return in equities is long term. Typically, the long term should be 10 years plus plus. So I would say 10 years should be a starting point. After 10 years, you are very comfortable that your principal will be broadly protected. You should not be sitting on drawdowns, and you would be on reasonable compounding in terms of your average return. So that is why we say always that long term. Now, just one example, if I have to give you, from 2014, when the Indian market started to do very well. So from 2014 to 2023, now we are okay. There are only 3 years which have been positive.
Mm.
And if you have been absent in those 3 years, your return is FD return. So 2014-15 was good, 2017 was good, and 2021 was good. Rest 5 years were all flat negative. 15 we went through correction, 16 was flat, 17 we went up, 18 we went down after the introduction of long-term gains, ILFS crisis, GST, demon, all these things. Then 2020 COVID happened. 2021 we saw a fantastic rally, and since 22 we are in a flattish kind of environment. So now, if you have been a investor since 2014 till today, you are sitting on a good compounding of 13-14%. But that is if you have been there in those 3 good years, and also in the bad years, yet you have made your 12 to 15%, right? So I hope you understand what I'm trying to say.
Yes,
That
yes.